Okay, chapter 12, partnership. What we're going to do here? We're going to deal with the partners. What's the tricky with the partners? Partners, they change their minds. Today they want to work together. Tomorrow they don't want to work together. 3 days after, they're going back and work together. That's the interesting part with the partnership. So let's see what kind of the form of the business that we have, that people can create a business, start a business. We have three forms of business. Once was purely proprietorship, where the single owner uh, work for himself. Then we have the partnership,
And we have the corporation.
and then we have the corporation. Now, what's the partnership? The partnership is obviously is
When you have to share everything with your partner and paying for the debits.
okay. How many people we need?
Two.
At least two. Can
Yeah.
be more than two.
No, I think.
Can can this group here right now that we have online, can we make a partnership?
I believe yes, but it'd be more efficient to make a corporation.
No, the question is, can we make a partnership?
I don't see why not.
Me neither. As long as we're looking for the same goal. In fact, we actually made the partnership. Are we not? All of us, we made a partnership for the period of the course. We have objective. You have your objective, I have my objective, but all the objectives are in the same line. We to pass the course. Make sense? So in a way, we have a partnership. Now, again, the pure definition for the partnership is association of two or more people who are together and to co-own the business in order to generate profit. Is there any formal requirements? No, there's no formal requirements. You don't need the permission from the government. You don't need legal procedures, nothing like that. What the partnership is going to combine is going to combine the asset, talent, experience, and there's no limit on the number of partners. So two people can get together, or three people, or five people, because maybe one half of the assets, the other half the talent, the third one has the experience. What's the oldest partnership in the history of the humanity? Do you know?
I almost want to say marriage. I don't know.
That's the right thing. You don't have to, you just said it's a marriage, yes. Is it a partnership? Yes, it is a partnership, right? Because two people getting together to share the business for profit. I mean, not profit in that term it will be different, but again, they're getting together in order to form something because they have together they have the same goal. Now let's see characteristic of the partnership. Partnership is association again of two or more people. It's voluntary. We may have a written partnership agreement, but we may not have. However, it's strongly suggested to have a written agreement. Why? Because people believe on writing. Long time ago, handshake was good enough. Today, we need writing. Even in a marriage, you need to put your signature in front of the witnesses.
Oh,
And that's how.
I thought you were gonna say always make a prenup or something.
No. The prenup is different. The prenup, we're gonna come to the prenup. No, the prenup is something different. So, what's the interesting with the partnership? Partnership always gonna have a limited life. It's not unlimited life. So, what will limit the life of the partnership? First, some of the partner may withdraw from the partnership. And once the partner withdraw from the partnership, that partnership is terminated. It cannot exist anymore. Some other partner may want to join the partnership. If we accept a new partner in the partnership, then the old partnership is terminated. And now we have to create a new partnership with the new partner. There's a mutual agency. Mutual agency means that it's very simple. Actually, mutual agency is if we are partners, let's pretend this class we are partners together, and some of us go to Las Vegas, get a little intoxicated, and start playing casino, and run out of money, and then go and say, I want to borrow 10,000 in the name of the partnership. He can do that. And after that, the rest of the partners have to pay it. As long as this part of the scope of the business. He may say, I'm here for the promotion of our partnership. So the mutual agency is any partner can bind the business to a contract within the scope of the business. So that person who went to Vegas can bind the partnership with the contract saying that the 10,000 that I'm withdrawing is for the advertising purposes of the partnership in terms of playing on some kind of games which can promote our business. And we, as a partners, we are all together. Unlimited liability. What's the unlimited liability? Each partner is unlimited responsible for the debt of the partnership with his personal belongings. So what that means is that we're going to build up on the example. If once the person signed the contract for $10,000 and the partnership says, well, we don't have money in the partnership, then the creditors can point out each of us and go after that person until the $10,000 are paid back. They can literally come to my house and start selling my TV. They can get the couch and anything valuable until they are satisfied and get the $10,000 back. That's the tricky part with the partnership. Now, we have the co-ownership of the property. That means whatever the asset one partner invests in the partnership become property of all the partners. So once, if let's say we're getting the partnership together again, same example, I bring my car in the partnership and put it as asset. All of you can use my car. Some of you brought his computer. All of us, we can use your computer. Now, the tricky part with the partnership is the partnership doesn't pay income tax. Then you're going to ask me, well, who's paying the income tax? The partners. The income from the partnership will be split between all the partners, and that's going to add to their personal taxes. And every each of us have to pay income tax based on his share in the partnership when he gets the money or when he gets his number of shares. You're not necessary to get the money. And the partners have those equity accounts. So each partner has his own capital account. And each partner is going to have his own withdrawal account. At the end of the period, we're going to see how much is in the capital account of each partner, how much each partner withdraw from his account. We're going to close the withdrawal account into the capital account, and we see what's left for the partner. Let's see advantages and the disadvantages of the partnership. First advantage is we can have various proprietorships. We can raise more. We can raise more capital when we are partners rather than when we are proprietorship. So basically, this one saying, why should I make a partnership instead of proprietorship? Because one person can raise one amount of money. If two people get together, they can raise more money. Not only the money, also two people working together always going to be more efficient than one person working by himself. One person can be good at one thing, the other person can be good at the other thing, and together they can cover all the tax issues when the clients need. That's why two people getting together to work together. Not because they're good at the same thing, because they're good at different things. The other thing is that partners work well together and can achieve more than. So basically, when you're a partnership, 1 + 1 is not always equal to 2. It can be more. Why? Because in the good partnership, the two partners can actually work together and cover the job for more than two people. What's the advantages versus the corporation? Less expensive to organize. What you need to do is just require article of incorporation, but that's for the corporation require article of incorporation and federal government and all those things. The partnership doesn't need those ones. However, strongly suggested you to have a written agreement, not as a general partnership. We have a general partnership. We have a limited partnership. We're going to see a little bit more, but strongly suggested to have a written agreement. On the written agreement, lay down everything. Get it signed, get it sealed. Also, partnership is subject to the fewer government regulations and restrictions. Corporation has more regulation and restriction that has to follow. Now, disadvantages. It will be very difficult to get partners to agree. And each time a new partner is accepted, we have to close the existing partnership and create a new partnership. So that means there are always changes in the registrations. The business can stay by itself, but we always have to change the registration. Relationship between the partners may be very fragile. And it's, as you already know from experience, it's very hard to find the right partner. Sometimes it's even impossible. The mutual agreement and unlimited liability make it partnership kind of tricky. You don't want to be with person who's going to drag you down every time when he gets something in his mind and starts signing contracts. And after that, you have to pay for the debt because it happened that you have more assets than the person who you're partnering with. And lack of continuity of the business, which the partners face compared to the corporation. Corporation is going to stay forever. The partnership, again, if the one partner decide I'm done, partnership's closed. The two partners decide to accept a new partner, old partnership is closed, new partnership is created. Type of the partnerships. We have this general partnership, which each partner is co-owner, have the same privileges and the same risks. Then we have limited partnership, in which limited partnership, at least one of the partners is general partner, means that he takes primary responsibility and all the risk of the business. The limited partners are limited only to the amount that they invested in the business. And then we're going to have a limited liability partnership when all the partners are limited only to the invested amount in the business. Now, the limited liability partnership can be used mostly for professions such as doctors, lawyers, accountants, and designated protected partners, that will be this is designated because the partners wants to, they don't want to get involved if another partner doing something wrong. The best way to do the partnership now is what I saw from my practice is partnership is created by the corporation. 2 or 3 corporations. So imagine this: 3 people wants to get together as partners. What they're doing is they're creating their own corporations, and then those corporations get into the partnership and will start working together. So even though it looks like might be general partnership and each partner is unlimited responsible, when you look at the partner, there's no individual who is a partner of the partnership. There's a limited company. So in that case, the creditors and investors can go only after the limited company, but it's limited only to the capital. So you open your corporation, you invest in $1, you open your corporation with $1 invested capital, that corporation get into the partnership with another corporation. If somebody wants to chase you, he's gonna end up with $1. And that's all. That's another way to do the partnership. Now, what's the difference between the financial statements between the partnership and the proprietorship? Now, let's see first and explore it. Revenue is the same. There's no changes in the revenue. Net income is the same. Both companies have the same amount expenses, they have the same amount net income. However, how we gonna allocate the income is different. In the proprietorship, all the income belongs to the one person, the individual who opened the proprietorship. In the partnership, that's not the case. That net income has to be allocated based on the partnership agreement between those 2 partners. And that not necessarily can be 50-50. Then we're gonna have a statement of the owner's equity, which statement's always gonna start with the capital at the beginning of the year. We're gonna add the additional investment. We're gonna add the net income, and we're gonna see how much we have. We're gonna deduct the withdrawals, and we're gonna see how much left to carry forward for the next year. In the partnership, we're gonna have the same thing, but it's gonna be split by 2 based on each partner's account and based on each partner's shares in the company. That's why we're gonna have investment for first capital for each partner, investment for each partner, then net income, which is distributed from the net income of the company to each partner based on whatever they decide to allocate it to. Then we're going to have the withdrawals, and then we're going to have the capital of each partner's account. Now the balance sheet. On the balance sheet here, we're going to have only one owner's equity, which is the person who created the partnership's capital, where on the partnership, we're going to have 2, 3, 4, depends on how many partners we have in the partnership. We're going to have all those people here listed. Combined is going to give us the partner's equity. On the other side, we're going to have the assets. We may have some liability, but that's. So let's go with the first question. What do you think about this question?
Blue.
This one is kind of tricky. In order to get this, we have to stick with the name. And the limited partnership is the one that has at least one general partner. Who take out the risk? The rest are limited. So knowing that, how are you going to answer this question?
False.
It's false, right? What has to be? It has to be limited liability partnership. When it's LLP, when you see the lawyers are usually LLP, limited liability partnership, because they're limited only to their investment. And that's in that case, if it says here limited liability partnership, then that will be true. Let's see another one. Some says B. Will everybody agree on that B? I have 3 Bs. Anyone? Any other suggestions? B, okay. Let's move on then. Let's see how we're gonna count when the partner initially invests money in the partnership. So, how are we gonna form the partnership? The new partnership starts with the journal entry, obviously. Same as the proprietorship. Same as the corporation. When the partner invests, what the partners can invest? Give me options. I want to open, let's open partnership. All of us gonna open partnership. What kind of asset we can invest?
Cash.
Cash. That will be easier, right? Debit cash. What else we can invest?
Plants.
Sorry, clients. Okay, debit clients. But that will be kind of intangible assets. What else?
Sorry, I said lands.
Land. Okay, we can land. Okay, land. What else we can invest? Can I
Equipment.
equipment? Can I so watch this. I have a cell phone, which is brand new cell phone, just 1 month used, but has 1 year and 11 months left on the contract, which contract I have to pay every month for $50. Can I invest that cell phone in the company? In the partnership, sorry. Can I put that cell phone as investment in the partnership? What do you think? Yes, I can. Okay, so that will be debit cell phone, right? For the value of the cell phone. But I have remaining on the contract. If I already put it in the partnership, and now the partnership on the phone, who's gonna pay the remaining 1 year, 11 months on my lease? Me or the partnership? What do you think? The partnership, yes. All the partners. So in that way, I can invest the assets, but I'm also investing related liabilities which are with that asset. Make sense? So now how much will be my inclusion in my account in that case if I invest the asset with the attached liability for it? Only the net contribution, which will be asset minus liability. That will be only the portion that's going to go to my account. So let's see example here. We have those two people which form the partnership. Make sense? So let's go and I'm going to copy this and let's flip it to the Excel spreadsheet. And let's start working on the Excel spreadsheet rather than sitting here and doing this. Just a second, I'm gonna share my screen in a second. Can you guys see my screen?
Yes.
Yes.
Okay, this is what's happened. On June 1st, 2017, this company, to develop and sell software, those two people decide to open the partnership to develop and sell computer property or computer software. So the first person contributed cash of $10,000, inventory $40,000, accounts payable $80,000, computer equipment 800, accumulated amortization 200, with the current market value 450. The second person contributed cash 5,000, computer software with cost 50,000 and current market value $100,000. So the question is, what kind of entry I can do on June 1st for that's January, let's go with the June 1st. That will be 20 something 7. So the first partner, Kathy, what will be her entry? What did she invested? What the company get? Oh no, sorry, the company partnership. What the partnership get? Debit,
Cash.
cash. How much cash did the partnership get?
10,000.
10,000. Okay. What else the partnership get?
Inventory.
Inventory. How much?
40,000.
40,000. What else we get?
Computer equipment.
Computer equipment.
Computer equipment. Debit equipment. Computer equipment.
800,000.
800,000. Think about it. What will be that? 800. So imagine this. I bought this computer for 800 computer equipment. I get this computer equipment for 800,000 5 years ago. I use it myself for my proprietorship and I already deducted $200, $200,000 depreciation.
600,000.
Now I'm checking the current market value of the equipment, and the current market value of the equipment is $450,000. What's the value of the equipment that you're investing in the partnership?
150,000.
Sorry,
Is it 150,000?
how did you get 450?
So I did
So
800.
no. Let's forget about this. Forget about this. Watch this. Different example. Couple get married. Right? Couple get married. At the marriage, they decide to combine their assets. The husband, his parents left him apartment, which they bought for $20,000 30 years ago, with amortization $20,000, with amortization $18,000, and the current market value $1 million. How much the partner contribute? How much the husband contribute to the partnership of the marriage?
1 million.
1 million. Is that clear?
Mm.
Yes or no? Is this clear for everybody?
Yes. Yes.
So what we chasing here? Do I chasing my original purchase price?
No.
No. Is that relevant for me? No. Am I worried about the accumulated amortization up to this point for something that somebody bringing to the partnership? No. So what I'm worried about? What's the market price?
Okay.
Make sense?
Yep.
That's how much he contributed to the partnership. So what's the current market price for this computer equipment?
450,000.
450,000. Boom, done. What else this person brought into the partnership?
Uh,
Who's gonna pay the accounts payable? Can the person contribute accounts payable? So watch this, people. I'm bringing to the partnership. We forming the partnership. I'm bringing my car. Which car is currently on the finance? I bought it 5 years ago for $90,000. Has been amortized, which has 45,000 amortization, and has remaining on the loan $20,000. Current market value of the car is $40,000. So what I'm bringing to the partnership? Do you want me to repeat here? I'm bringing to the partnership car with 90, which I bought originally 95,000. I use it for 5 years, and now I amortize it to now amortization. I already put amortization 45,000. I have remaining on the loan, still payable on the loan 20,000. Current market value of the car is $40,000. What I brought to the partnership? I brought the car, right? So I brought the car for $40,000 plus accounts payable of $20,000. Make sense?
Yes.
Okay, same thing here. What the person brought to the partnership? 80,000. So let's give him the 80,000. Accounts payable. Now the partnership has to pay $80,000. And are we in balance?
No.
no.
No. So what's going to happen with the remaining credit? Where the credit's going to go? It's going to be Kathy Zeng capital account or partner's account. Now, in her capital account, she's going to have this plus this plus this
Minus 80,000.
minus $80,000. So, net amount that Kathy brought to the partnership is $420,000. Make sense?
Yep.
How about that's for Kathy, right? Let's see. Chow, what's Chow brought?
Cash.
Name it cash. How much? 5,000. And what else?
Market value.
What is this? Computer, right? Credit.
Yep.
Computer software. Market value is 100,000. And that's all, right?
Yep.
So which account? So that's debit. Sorry. Which account I'm gonna create now?
A capital account.
Credit, Chow, capital account.
Because there is no liability.
Right. There's no liability on Chow. Capital account, and that's gonna be this amount plus this amount. So at this point, if I have to do a balance sheet for this partnership, what do I have? I have current assets, right?
Yes.
Which are my current assets?
Cash.
Cash. What else?
Inventory
Inventory.
and the equipment.
Equipment. That's a long-term assets, right? Those two will be only the two. Then we're gonna have long-term assets. And that will be equipment. And computer software. Correct?
Yeah.
And that's all.
Yeah, for the asset.
Okay, so how much is my cash? 10,000 plus
The 5,000.
5,000, 50,000 cash. How much is my inventory?
40,000 only.
40,000. Total assets. My total assets are
55,000.
55,000. Then I'm gonna have my total assets. Let's make it this way. 55,000. Sorry. Then I'm gonna have long-term assets, which are computer equipment of 450. And I'm gonna have here software of
Computers.
100,000.
Yeah.
Correct?
Yeah.
So the total is
55,000.
550,000.
Yeah.
Sorry, like this. And my total assets are what's my total assets?
This one plus this.
This is my total assets, correct? Now let's go with the on the other side, I'm gonna have liability, correct?
Yeah. The current liability.
What's my liability?
80,000.
Accounts payable.
Yeah.
And that will be the only one, correct?
Yeah.
80,000. So the total liability will be 80,000. Let's put here total liability. 80,000. Then I'm gonna have equity, correct?
Yes.
Let's go with the equity. What will be in my equity?
A capital account.
Capital account, CATI,
In the capital account for
and
the
capital
second part.
account, CHAO. How much will be in the capital account of CATI?
For 20,000.
420,000. How about CHAO? 105.
Yep.
How much is my total equity?
$500,000.
My total equity will be
5,000.
like this, 525, correct?
Yeah.
Let's put it here. Let's get this one and put it here. And how much is my total liability and equity? Should be exactly the same, right? Not in this case. So what I have to do is gonna have to drag this formula up a little bit. This is my formula. I have to drag it all the way up. Now we have a problem, correct?
They're not in balance.
They're not in balance. Now we have to find out why they're not in balance. What we did wrong.
Did you add the current asset with the long-term assets, the total?
Those two I did.
The total asset, it should be, I think, 55,000, 5,500.
Yeah, this one should be that one. So we have to extend this formula a little bit up. And now we're in balance.
Yeah.
Make sense? And now we have our balance sheet for this small partnership. Are you guys with me?
Yes.
Now this partnership can start generating income, correct? Now every time when the income is generated, where the income is gonna go? In the partner's accounts. Make sense?
Yeah.
Now let's keep going. We're gonna go now with the slides. Let's go back to the slides and let's keep building on the slides. So the first one, cash, inventory, computer equipment, accounts payable, capital. Second one, cash, computer software, Mr. Chow, capital, $100,000. If we have to prepare again the balance sheet, that's how it's gonna look like. Cash, inventory, equipment, computer software, total assets, accounts payable, partners equity. We're gonna have Cathy account, capital account, Chow capital account, total partnership equity, liability and equity at 605, 605. Let's do this question now. We have two people, Lucy and Vera. They decided to form partnership. Lucy invested 5,000 cash, while Vera invested inventory 5 and cash 2. What's the balance on Vera's capital account after the formation?
A.
Everybody see A as an answer. Okay, a lot of people see A. Let's move on then. Let's see what we're gonna do when we have profit and loss in the partnership. Now, the partnership start working. The start generating revenue, start generating expenses. Now, what's the interesting thing is partnership, partners, they sharing everything. They sharing the profit and they sharing the losses. How they sharing those one? Based on the partnership agreement. That's why it's very important you to have a proper partnership agreement. Because if there's no agreement, or the agreement doesn't state how to profit and loss share, then we're going to allocate the profit and losses to the partners equally. What means equally? 50-50. Now, the partnership agreement can have a different kind of structures. It can be based on the fraction. One person gets 70% of the income, the other gets 30% of the income. But can be based on the amount of money that each partner invested. So based on my initial investment, I'm going to get proportionate part of the income. How are we going to get this? We're going to see how much first invested. We're going to see how much second invested. That's going to give us the total. From the total, we're going to get proportionate percentage for each partner. And that we're going to use every time when the company generate profit and losses. Don't forget to allocate to the partners losses. Because they have to get everything. They're sharing. The other one can be based on the partner service. And the last one can be a combination of any of those above. But don't forget, if there's no agreement, and if the agreement doesn't specify how to allocate the profit and losses. The partners sharing everything equally. If there are two partners, they're sharing it 50-50. If there are three partners, they're sharing it 33, 33, 33, 33, 33, 33. If there are four partners, 25, 25, 25. Sometimes, I'll tell you from my experience working in the partnership, it's very hard to please everybody in the partnership. I was working in partnership with three people. Obviously, the income has to be split by three equally. That's how they had the general agreement. There's nothing specified on how the profit and losses are shared, so I have to allocate it at the end of the year equally. Now it's very easy to allocate by three if it's end up is the amount is divided by three, but that's not always the case. So what that means is the two partners can get one amount, the third partner amount can be less, usually it's less with 1 cent. Make sense?
Yes.
So, I'm telling you this from experience. So I'm allocating the amount, and the partner who gets 1 cent less coming to me and start saying, why I'm getting less money than the other people? Why are you treating me differently? That's not fair. I want the same amount that the other people are getting. What do you think I did? I solved the problem very fast. What do you think I did? Any suggestions? Any guests?
Sorry, can you repeat your question again?
So the question is, the three partners I have to divide at the end of the year. I divided the income to those partners. For the two partners getting amount. The third partner get, because the amount cannot be divided by three. The third partner get 1 cent less than the other two partners. The partner who get 1 cent less than the other two partners coming to me, very angry, very upset, and telling me why I'm getting less money than the other two people. That's not fair. I want to get the same amount. I solved the problem right away. Can you guess what I did?
Did you give him cash?
I reach in my pocket, I get 1 cent, and I give it to him, and I said to him, that's your cent, please leave me alone. That's exactly what I did.
Okay.
I know it sounds ridiculous. I know it sounds unrealistic, but I'm telling you, when it comes to the money, people are greedy. And when they see that they're getting less than the other people, even if it's talking about 1 cent, you have to be able to solve the problem if you're the one who's doing the allocation. So be prepared for those situations, please. You never know what's going to happen. Now, let's go with this one now. Let's start sharing based on the fraction. I'm going to copy this. And let's move it to the Excel spreadsheet. And let's go to the Excel spreadsheet. Can you guys see my Excel spreadsheet?
Yes.
Okay, this is the question. I'm going to erase everything. We don't need this one anymore. And I'm going to get rid of those. So Now, assume that the partnership has agreement. We have two partners. One is Shannon. One is Shannon. And the other one is Raul. Partner one, partner two. We are allocating 2/3 of the profit and losses. So 2/3 goes to Kerry, to Shannon, and 1/3 goes to Raul. Now I have to get the percentages. Tell me what's the percentage of the Shannon and what's the percentage of Raul. Are you typing somewhere?
For Shannon, is it 0.66?
It's gonna be 2 divided by 3, and the other one will be the remaining, right? It's gonna be 1 divided by 3, and it's gonna get this percentage as well.
33%.
Right. Okay, so now, question for you. If I have those two partners, and they sharing the profit in ratio 5:7, what's the percentage? How can I get the percentage? Okay. Yeah, Carol, go for it. Tell me. First, what I have to do, I have to get the total, right?
Yes.
And then I'm gonna get 5 out of 12 and 7 out of 12, correct?
Yes.
And that's gonna give me my percentage. 5 divided by 12 is gonna give me the percentage, and it's gonna have here 7 divided by 12 is gonna give me another percentage. What I have to do is just flip it to percentage and show you the decimals. That's how I'm gonna get it. Make sense?
Yes.
Now, what if I have 3 partners? Let's add those 2, and let's add another one. Third will be, tell me one name. Let's go Kerry. I have here Kerry. Kerry. Okay, so now they sharing the profit 3 to 4 to 1. What's the percentages?
For Shannon is 6%.
Sorry?
For Shannon is 6%.
How did you get it?
So I add all of them. Oh, sorry. No, my bad.
First you're adding all of them, 8.
Yeah.
And then you start getting 3 out of 8.
Yeah.
And then you're getting 4 out of 8, 1 out of 8, getting the percentage and see what's happening. Is that how you get it?
Yep.
Okay. So now we know how to get those ratios. Let's go with our example, which they're sharing 2 to 1. Now they're sharing 2 to 1, which is transferred to 2/3 out, 2/3 and 1/3. So how much the income of the company is $60,000. How much goes to first? How much goes to the second? Well, we're gonna use those ratios, right? And we're gonna see how much goes to first. This one time the percentage. And they're gonna get the second. We're gonna get the second one. So what will be our journal entry here? Debit. Debit. I'm looking for debit. We're not giving them cash. They're not contributing cash. We giving them income. We allocating the income here. When we're allocating the income, obviously we have to credit their accounts. Credit first Shannon account, Shannon capital. In Shannon capital, we're gonna put the 60,000, the 40,000, and then we're gonna have credit row account, capital, and that will be 20,000. Now the question is, which account I should debit?
Income summary.
Income summary. Make sense? Income summary, we gotta debit it with the exactly the same amount, 60,000. And our job is done. Now we allocated the 60,000 income to those two partners. Questions? Okay, let's move to the slides. So, income summary debit 60,000, capital carry 40,000, capital row 20,000. We allocated the income. Now let's see another one. Now assume that the partnership had losses $15,000. Same scenario, but now they have a loss. What we gonna do with the loss? Let's forget about this and let's go to the Excel spreadsheet. Gonna flip it on the new worksheet, get rid of this, and let's paste this one. Now, assume that the partnership has loss. What we gonna do? Well, the same thing that we did with the profit. In first case, let's put it here. No, sorry. Let's cut it from here. Let's put it right here. In first case, they have a net income. Now they have a net loss. And the net loss is negative 15,000. So what's going to happen? Same thing, but different way. So can I do this? Can I do the entry this way?
Now we have to debit the capital and credit the income
Exactly.
summary.
Exactly. So now we have to change the entire entry. So let's change it. We're going to have debit
Shannon capital.
Shannon capital, debit row capital,
Shannon
and
14,000.
credit will be income summary. And the Shannon's gonna get
10,000.
10,000, but that will be now positive amount. Let's make it positive. Arrow is gonna get 5,000, and the total we are allocating is 15,000.
15,000.
and we're done. Make sense?
Yes.
Yes.
Okay, let's go with the next one. Now, what we have here, suppose that these people are in the partnership and they have the following balances. Let's get this information and let's flip it on the Excel spreadsheet. Oops, not this one. Wrong sharing. Let's go with the right one. This one. Let's get this information now. Let's flip it here. So now I have those two people. Three, sorry. Three people. What we have? We have John. Capital. We have Erika Capital. And we have Tony Capital. And we have the amount in their capital. One invested 120,000. The other invested 180,000. And the third one 150,000. In total, they invested 450,000. Now, the next part of the question is, net income for the year. Can you guys see the question?
Yes.
So let's put it here. Net income for the year is $300,000. Now we have to allocate it based on the proportion of the invested capital. Now, what we have to do? We have to get the percentages. How are we going to get the percentages? Capital divided by the total, right? We're going to get percentage for the first, second, and third. The total should give us 100%, correct? Let's put this into percentage, show the percentages, and that's how we're going to allocate it. So, based on the $300,000, so we're going to have net income. That's income is $300,000, and we have to allocate it between those three people based on their percentage. Correct? Now the question is, how much of those 300,000 each of them is going to get? And we're calculating this one times the $300,000, and we're going to get the total that has to be allocated. Make sense? Did we allocate 300,000? Yes, we did.
Yeah.
Let's do the journal entry now. Who's going to help me with the journal entry? David.
Income summary.
Income summary with 300,000, and then we're going to have all those people on the credit side. Let's put this credit here. With all those amounts that left for them. Make sense? And we're done with this. Tony, let's give him some credit to Tony. And we have everything. Do you see anything different and any difficult and anything scary here?
No.
No.
Okay, let's keep going then. I want to finish this allocation, and once I finish the allocation, I'm going to give you a break. Next one. Now, assuming that these people form a partnership with the capital investment 50 and 50 respectively. First person devoted more time, 60% of the partnership, and received large portion of the allocation. Net income 125 is to be allocated as follow. First, 40,000 based on the capital investment. Next, 60 based on the services, which will Wallace receive 24 and Borugian receives 36. Remaining is allocated equally. So let's see who's going to get what. I'm going to copy this. I'm going to flip on the Excel spreadsheet again. And let's start working together to figure out who's going to get what. Okay, can you guys see my screen?
Yes.
Okay, let's get rid of this first. We don't need it. Pause the picture here to have it. What we have to do. So the question is, how much is our net income? The company net income that they want is
50,000. Sorry, 125,000.
125,000. That's how much we have to allocate, $125,000. So the first allocation will be based on the capital investment, correct? How much we're gonna allocate to the first one? We can allocate only 40,000, correct?
Yeah.
So if we allocate 40,000, that's here is gonna give us 40,000 minus. So that's not gonna be the one. Let's format this column like this. That will be. We need to deduct 40,000 and allocate 40,000. That will be one way, or you can go with different way. Let's go with different way to allocate. First, we have to allocate 40,000. Let's go this way. Who's gonna get what? Let's go with Michelle. How much Michelle's gonna get?
20,000.
She's gonna get 50%, correct? Why 50? Because based on the capital investment, they both invested 50 and 50,000. Or we can put it here. That will be equal to 50,000 divided by 100,000. Correct? Are you guys with me?
Yes.
Yes.
That will be 50,000 divided by 100,000. That's how much Michelle's gonna get, 50%. And that will be equal to 40,000 times 50%. She's gonna get 20,000. This to be allocated to the first partner, partner 1, and to be allocated to the partner 2. Let's see partner 2. Later on, you're gonna see why I'm doing it this way. Right now, you don't know, but later on, you're gonna see. Second one, allocation is to the second partner, which is Caroline. Same idea, 50,000 divided by 100,000. So that will be 50,000 divided by 100,000. That's another 50% here going to Caroline, which will be equal to 40,000 times 50%. That's going to be, however, I want it here on this column. So how much we allocated so far? We allocated, let's put it sum, all these amounts, correct? We allocated 40,000. How much left for allocation?
$85,000.
85,000. So what we're gonna do with the 85,000? The next 60,000, so second, that will be second. Second will be the next 60,000, it's gonna be Michelle get 24, Caroline get 36. Let's give them. Michelle, that's how much they want. Michelle and Caroline. Michelle get 24,000 and Caroline get 36,000. Just give me a second to format those one. So in total, how much we give them? Those two amounts, correct? We give them 60,000. The question is there anything left?
Yes.
How much left? That's not how much left.
25,000.
That will be how much left. Oh, that will be net income left for further allocation. Let's put it this way so it can be clear. 25,000. And that will be our third allocation, correct? That's kind of weird, though. That will be my third allocation, and the third allocation is going to be again to those two people. How I'm going to allocate the amount left? Equally, correct? What means equally? 50-50.
Yeah.
So how much Michelle's going to get? 25 times 50%. And how much Caroline is going to get?
Same
25,
amount.
25 times 50%. How much in total we distributed?
25,000.
25,000. Is there anything left for distribution?
No.
I have to change the formula here. Nothing left for distribution. Make sense?
Yep.
Everybody understand this allocation?
Yes.
Now we're going to start practice on this. There will be different scenarios here. So imagine the one scenario here. Here we have 125, right? Let's flip it on the new screen. We did with 125. Now the question is, let's go back here. Now the question is, what will be our journal entry here? First, we have to see how much Michelle gets, right? And then we have to see how Caroline gets. Michelle gets all this in money, correct? Caroline is gonna get all those money. In total, how much they both of them get? How much is the total allocated? How much should be?
125,000.
125,000. If it's not 125, that means we made a mistake, right?
Yes.
So all those amounts are gonna give us 125. So we have 125 and we give them 125. So we'll go all good. Michelle gets that much, Caroline gets that much. Give me the journal entry now. David,
Income summary
income summary,
for 125,000.
125, 1, 2, 3.
For Michelle, 56.
Then we're gonna get credit
Michelle's capital.
Michelle capital. And then we're gonna get credit
For
Caroline
capital.
capital. And each of them is gonna get, Michelle gonna get 56, and
500.
Caroline is gonna get 68,500. That's total of 125. Make sense?
Yes.
Now, I don't need this one because I don't need now new information. Let's get rid of this and let's flip it now. I'm gonna flip it now. And let's change this information a little bit. Now, let's say instead of, let me delete some stuff here before I continue. Instead of 185, the company doesn't have income 185. The company income is 85,000 only. Make sense? I'm changing completely the scenario. The company get only 25,000 income, 85,000 income. So what we're gonna do first? Well, first we have to allocate 40,000, right? Make sense?
Yes.
Let's allocate it. First 40,000 goes proportional to both of them. 50,000 divided by 100. That's too many zeros here, divided by 100. And Caroline is gonna get 50,000 as well, divided by, that will be equal to 50, 1, 2, 3, divided by 100, 1, 2, 3. That's too much percentage here. Let's get rid of this percentage amount, 50%. So Michelle's gonna get 40 times 50%, 20,000, and Caroline's gonna get 40,000 times 50%, that's 20,000. In total, we're gonna give them negative sum,
20,000.
40,000. We're gonna give them 40,000, correct?
Yep.
How much left for the further allocation?
45,000.
45,000. But now we have to do second allocation. The next 60,000, we have to allocate it. We have to give 24,000 to Michelle and 36,000 to Caroline. Can I do that?
No, we will have net loss, not the net income.
Yeah, but they want it. It's on their agreement says that the next 60 has to be allocated this way. So what should I do now? Should I still allocate in 60,000? Because they're saying this is on their agreement. It says the first $40,000 we share it based on the capital that we invested. The next 60,000, Michelle get 24,000, Caroline gets 36,000. Yes, I agree. We don't have 60,000, but that's what says on their contract. So what shall we do?
The percentages between the 24 and the 36 of the 60,000?
No, we're not making interpretation on their contract. And the contract says the next 60,000, we're gonna have to give them 24 and 36. And that's exactly what you're doing. You just follow the contract. You're not making interpretations. Regardless if they hear money or not. Why is that? Because at the end, the remaining balance is gonna be allocated equally. And since they're partners, don't forget, they're sharing equally profit and loss. Make sense?
Yes.
So, general rule, follow the partnership contract. Even if you here come with the negative amount, give them what they want. Why? Because at the end, they're going to share everything equally. So let's see what's going to happen now in this situation. How much we're going to give them in total? In total, we're going to give them 60,000, correct?
Yes.
Now, how much left for the further allocation? It's not 60. You have to go and change the formula here. How much left for the further allocation?
15,000.
Negative.
Yes.
So how I'm going to allocate those 15,000 negative? Equally. Make sense? Do you understand this?
Yes.
This is the key here. I want you to understand this thing. Right now, we allocating loss. Well, it's loss, take it. You wanted 50-50. We give you what you wanted, whatever left, split it 50-50. So what's going to happen now? How much Michelle's going to get? Michelle's going to get
7,500.
negative.
And
And
if
Caroline's
75.
going to get this one time 50%, that much.
Yes.
And in total, how much we allocated?
Minus
Minus
50,000.
sum of
The minus.
that much,
Yep.
right? So how much left for allocation?
A zero.
Should be zero here, right? Let's make the formula zero. Make
But-
sense?
Yeah, but the journal entry will
So
be
now,
opposite.
hold on a second now. Hold on a second. How much is the income that we have to allocate? 85, right? We are still on the income summary. Income summary is still on the debit side. 85,000 is the income. But now the amount that each of them is going to get, it will be different, correct? Make sense?
Yes.
Do you understand this logic? We're going to practice this again because this type of question is going to come. I have to see if there's anything like this in Pierce, and I know if it's on paper, I have to give you this question on the final exam. But I don't know. I have to see if the Pearson have these options for this question. So how much in total we allocated to those two ladies?
Some of these two numbers.
Some of this, which has to be how much? 85,000. Did I
Yes.
meet my goal? Yes. Now I'm gonna go extreme scenario now. Okay, one more scenario. Let's make one more twist here. What if in the beginning the company generating loss of $30,000? What should we do now? Any suggestions?
Allocate the loss to the owners and credit income summary?
Again, follow the contract.
They still have to.
Again, the general rule here is
They still have to.
regardless, ignore the starting point. Is it loss? Is it gain? Is it profit? Is it whatever it is? You don't care. Follow the contract. What the contract says. The first $40,000, give them equally. Give them equally. Give them the $40,000. They want it. Give them the 40,000. So what I'm gonna do? 40,000 times 50%. That's gonna go to Michelle. Then there's another 40,000. There's another 40,000, 20,000. 40,000 times 50%. That's go to Caroline. What is now left for allocate? Negative 70. What's the next thing? They want $60,000. 24 for Michelle, 36 for Caroline. Give it to them. Whatever they want, give it to them. 24,000 wants for Michelle, fine. 36,000 goes to Caroline. How much left for allocation now? $130,000 negative. Now, get them to split that $130,000 equally. Make sense?
Yes.
So what's going to happen? How much Michelle's going to get? Michelle's going to get 50% of this,
65,000.
and Caroline's going to get 50% of that. Did we allocate? So now total, we allocate everything. There's nothing left to allocation, right? So now let's see what's happening in their accounts. Who's going to get what? Michelle's going to get 21,000. Caroline's going to get 9,000 loss. Did we allocate 30,000 loss?
Yes.
Yes. So now what I have to do, I have to change this entry. What will be my entry now? Debit,
Capital.
Michelle capital of 21,000, right? Debit, Caroline,
Capital for 9,000. And credit income summary.
Let's put this one 9,000 here. That will be negative 21,000, and then will be debit, credit, income summary
For 30,000.
for the 30,000 loss. Make sense?
Yes.
Yes.
Again, if it comes to whatever scenario, whatever the starting point is, ignore it. Because at the end of the question, they're gonna share everything equally. So give them whatever they want. Give it to them. Because at the end, don't forget, they're sharing everything. They're sharing profit, they're sharing loss. That's how it's in their contract. And don't forget, at the end, you always have to allocate between those two, whatever you have the starting point. Those 2 points always have to be equal. Now go for break, and I'll catch you in how many minutes break you want? 15? Okay, Elena, 15 minutes break. I'm gonna catch you what time? Give me time. 10? Now, okay. Caroline, 10, 15? What time you want me to start?
40.
40? Okay. So again, those two people, first they're allocating first 40,000 based on capital investment, next 60 based on the service, 2436, remaining 50/50. And how we're gonna allocate it? The first 40 goes to 20 each. Then this next 60 goes 24, 36 until we allocate 60. And the last is 12,500, 12,025 allocated. We see how much each of them getting, how much in total we allocated, and then we preparing the journal entry. Now, another method is the interest allowance method, which is calculated as a percentage of their capital balances. That might be another one. So basically, let's do this together. Let's see another allocation. Another twist of allocation, and you're going to get sense of everything. Let's move to, I'm going to grab this scenario here, and I'm flip it right here. Get rid of this and pose the new question. So now we have to change. I'm going to change in the middle column. This one. And I'm going to get rid of those allocations. And let's start from the beginning. Now, remember, the first point is how much we need to allocate. That's a starting point, always. So what's the net income that we have to allocate?
240,000.
240,000.
240,000. Okay, we put it this one. And let's put it in the income summary. That obviously will be 240,000. Trying to make this Excel spreadsheet kind of universal. So now this one is working. Now you have to go back and to change those one. I'll try to change it after the class. Today I'm going to change it before I post it and make it available for you, if that's okay with you. So it can be a little bit more interactive and you don't have to figure out the formula and anything. Once you put the data, everything's going to start calculating. But the whole point is you to understand how to make this one. So let's go with this. We have to allocate 240,000. Now, from those one, first allocation is, we have two people. Now is we're working with Edward. And the next one is Pierre. Now, what the Edward wants? Edward wants salary, right? How much salary he wants?
107,000.
Give it to him. Whatever he wants, give it to him. We're not arguing with them. Second one, Myers, he also wants salary. How much salary he wants? 88,000. Give it to them. How much left for allocation? 45,000. Second, they want 8% interest on their beginning capital balance. Okay, that's what we have to give them. That's what we have to give them. Let's insert some lines here. Well, let's say first one is Edward. He wants, how much was his capital? 200,000. On the 200,000, we have to give them time 8%. Whatever he wants, just give it to them. Don't argue. That will be interest. And 200,000, 1, 2, 3, times 0.08. 16,000 goes to him. Second one, Pierre. He also wants 8% of his capital balance. His capital balance was 250, and we're gonna give him 8%.
20,000.
Interest. So he's gonna get
20,000.
250,123 times 0.08. 20,000. We give them another 36. How much left for allocation? 9,000, right? How are we gonna distribute those 9,000? Usually the last allocation is equally. So that will be 50, 50. So left to allocation, 9,000. So that will be 9,000 times 50%, and another 9,000 times 50%. Did we allocate everything?
Yes.
Yes. How much Edward get? Let's change the name here. Edward get 132,000. Pierre get 108,000.
You allocated the 4,500 of Edward to Pierre,
Which one?
the last 50%.
Oh yes, I did. Now Pierre is gonna go after me, right? He's gonna say, "What are you doing? Why he getting too much? I'm getting too less." Here we go. Thank you. Bottom line is be careful with the partnership. The partners are very sensitive when it comes to the income allocation. Follow the contract, whatever says on the contract, just give it to them. I can give you, do you want a twist on this question? Yes or no?
No.
No? Okay. Let's move on then to the slides. So here allocation again, give them the salary first for the services, then give them the percentage of the beginning capital, and the last thing that left is split it by 2. Whatever left, give it to them. Now, what's going to happen if those two still the same, but now the net income is 2005? Again, you give them the salary, you give them the interest. The remaining is divided equally, even if the amount is negative. So basically, you follow the contract, whatever happened at the end, divide it equally. Now let's see what's going to happen with this one. Jennifer, you didn't want the twist, but they make the twist for us. So what will be the twist here? Instead of 240,000, net income is only 205. So if we plug this 205, what's going to happen? Most likely here will become a negative. Make sense? On the first allocation, once we give them the salary, you can see that we only have 10,000 left to allocate, but they want interest. Well, if they want interest, give them the interest. But it's more than what's left. It doesn't matter. Just give them what they want. Because at the end, they're going to share everything equally. Make sense?
Yes.
So the other option here is if income at the end is only, let's say the income first year, let's say this is a first year of operation, and the income is only $100,000. Right? So now the first person getting a lot of huge salary. More than the one. Let's say the Pierre now wants, he doesn't want salary. How about if he wants without salary? Is that going to be fair for him? Let's say if he doesn't want salary, then what's going to happen? Watch what's going to happen now. We're going to allocate $100,000 income. Pierre, no, Edward's going to get increase in his capital account. That we have to change. I have to change here the name. That will be Edward here. Edward's going to have increase in his capital account. What's going to happen now with Pierre? Is he going to get increase?
No, decrease.
No, he's going to get decrease That will be here debit on the Pierre capital.
Capital.
And how much will be that debit? That will be equal to negative of this amount. Make sense? So you see, even if there's an income here, one person getting increase in his capital, the other one getting decrease. That might be possible scenario. There's another scenario here. Let's see, let's go over the slides. And there's another interesting scenario when the company generating income, generating loss, but one of that loss, it doesn't transfer to the loss of one of the partners. So let's see here, allocation. Again, we are allocating first the salary, then we are allocating the percentage, and then allocating the remaining negative amount to both of them, and everybody gets his shares. Is it possible? So now we're going to scenario where the partner withdrawal of cash and other assets. So for the withdrawal, before I continue with this, I want you to make it clear for you. For the exam purposes, for the final exam, this chapter will be tested up to the profit and loss allocation. Nothing else. Make sense?
Yes.
So that's for the final exam purposes. Now on the quiz, the quiz is going to have a chapter 12 and chapter, what was the other chapter? Chapter 15. On that quiz, I might include question from the withdrawal. I say might. I'm not certain, but if I include question from the withdrawal, I'll let you know. Okay? But there will be no question for the withdrawal and anything like that. After this point, after slide 32, there will be no questions on the final exam. That's why the assignment for chapter 12 is for practice. You may have different problems, but that will be only for practice purposes. So now let's go with the withdrawal. Well,
Sorry.
yes.
I just have a question for the solution we did at the last thing. So now when Pierre has the net loss, they gonna both pay for his net loss, or only Pierre he gonna pay for his loss?
So watch this. The company gets income.
Yeah.
Right? So debit, income summary. That's no questions about it with income.
Yes.
Now, how we are gonna allocate this income is the different story. So in this case, Edward have increase in his capital more than the income.
Yes.
But Pierre is going to have decrease in his capital with that much. Now, what will be the capital of, since we have the beginning balance as the capital, what will be the capital after this year, after the allocation? Well, Edward capital will be, beginning balance was 200,000, and we added to his capital account plus 101,500, right? So
Yes.
his Edward capital in total will be, come on, give me the total, $301. Now, what's going to happen with Pierre capital?
Will be less.
Now, he started with 250,000, but now we're going to deduct 1,500.
Yes.
So his capital is going to be that much.
Okay.
You see, that's the partnership. So now, in this case, you can have so many interesting scenarios. And I'm telling you right now, on the questions that I'm going to give you, I'm not going to give you the standard scenario when both of them ending up with increasive capital. That's too boring. There's no challenge here. I'm going to change scenario when there's a loss, for example.
For one of them.
No, on the income, when you're not starting with the net income, we're starting with the net loss. But turn out that one of those getting increased of the capital, and the other have huge decrease in his capital. Something like that. That's possible scenario here. The other possible scenario is the one that you're seeing right now. It's net income, but that net income doesn't go to one of the partners getting deduction in his capital. He's not getting anything from the income. In the contrary, he paying from his account to the other partner. That's how you should look at this. So those are the possible scenario that I'm gonna look. And the other thing is I want to make sure that you understand that even though you're seeing here negative amount for allocation, you keep following the contract. Even if you see that this amount is less now, okay, I have to allocate, for example, here you have to allocate 60,000, but I have only, I'm negative 70. It doesn't matter where you are. Just keep giving them what they want. That's the whole point here. So watch this. This one is possible scenario here. Watch this. Let's say here they started with, let me play a little bit with the numbers. The net income is negative, correct? Are you guys with me?
Yes.
Yes.
So watch this. The net income is negative. First, we give them 20,000. First 40,000 based on their investment. Now the second allocation is based on the service provided, right? But let's say the Caroline, based on her service, she gets $50,000. No, more. Let's say 60,000. If it's 60,000, watch this. Caroline gets $60,000 instead of 26. We make it 60,000. So what's happened now? Now on the next stage, they have to share loss of 154, which they sharing. And in this case, what's going to happen now? Michelle's going to take a reduction in her capital of $33,000. Now the Caroline, now she's lucky. She's getting increase in her capital. Of $3,000. So you can see now how the partnership can lose money, but even though the company losing money, the partnership losing money, one of the partners getting increase his capital. Is this possible scenario? Absolutely. So that's why it comes to the point, how are you going to make your original contract, and how are you going to make the allocation of the profit or loss in the very beginning? And that's why even in the years that the partnership losing money, you still may end up with increase in your capital, and the other partner take the huge loss. So in this case, Michelle get the loss, 30,000, plus she get additional loss from the Caroline increase in capital. Make sense?
Yes.
So those are the challenges that I'm gonna chase when I try to test you. I'm telling you right in the beginning, because I believe this is more interesting rather than pure allocation of the income when both partners getting part of the company end up with income, and they both getting the same, both sharing the income in whatever the way they're sharing it, right? That's for me, that's boring. If I want to challenge you, I'm gonna challenge you with questions like this, or questions like this, where there's a difference, right? One getting one, the other one getting increase in the capital, the other get reduction of the capital. So now you saw all the possible scenarios that can come from this type of questions. So let's go with the withdrawal. Obviously, at some point, one of the partners is going to say, I'm done with this. I'm done with this partnership. I want out. So what we have to do? We have to close his account. So let's see possible scenarios here. First, what we have to do, before we do anything, we have to allocate the income. Now, assume that Edward each withdraw 12,000 per month. I don't know what where this one withdraw. I think this is some kind of. Oh yes, this is for the closing the withdrawal account. If they drawing the money from the withdrawal account at the end of the period, we're gonna close the withdrawals into their capital account the same way that we did with the proprietorship at the end of the period, if you remember. Remember on the closing entry on the proprietorship, first we're closing the income summary, and the next one that we're closing was the withdrawal account. Where we're gonna close the withdrawal account? Into the partner capital. And we're done with this. Make sense?
Yes.
Okay. So let's do this question. Probably do you want me to use the Excel spreadsheet or you want me to give you time to figure out? Okay. I have an answer here already. B. Everybody see B as answer? Okay. Let's go with this one. What's going to happen if we want to get a new partner? Now think about it. Why the partnership want to get a new partner?
Is it because of the expenses?
Yes, because we cannot handle the cash and we would need a person who has cash. Right? That will be one reason to accept a new partner. The other reason to accept a new partner is we're lacking of knowledge of technology. We want somebody who is more technology person to come to the partnership so he can help us with that. Now there are two options in this one. We're gonna purchase there's a two option. We're getting the new partner when the old partner try to get out, or he investing directly and increasing the number of the partners. In both cases, original partnership stopped to exist. And then we're forming a new partnership. So that's the tricky part with the partnership. Every time when the new partner comes, the original stops. And we're opening the new one. Now, the old partner, if the new partner purchased the old partner, then we have to first, the old partner capital account balance is transferred to the new partner account. And the price paid between the new partner and the old partner, that's not relevant to the partnership. So we just accepting, we're replacing one partner with another partner. One partner wants to go out, the other wants to step in. So he keep the same account with the same balance. How much they pay between each other, that's not part of the partnership. Second option is the new partner invests asset into the partnership in exchange of the share of the business. So there are three options here. He can invest exactly at the book value. He can invest above the book value and give the bonus to the existing partners, or he can invest below the book value and receive the bonus of the existing partners. So now let's see the scenarios. First scenario, the existing partner of Hardy and May partnership, that Hardy capital is this much, May capital is that much. Devon comes to the picture and he invests in equipment and land with the market value $80,000 into the partnership. How much he's going to receive? So in order to do that, I'm going to move again to the Excel spreadsheet, and we're going to explain this on the Excel spreadsheet. Now we're going to get one of the very, very first one. Not this one. I'm going to flip it here, and now we're going to get the new question. Can you guys see my screen?
Yes.
Yes.
Okay. So in this question is, the whole point is this. Hardy capital is 70,000. May capital is 90,000. Correct?
Yes.
That total is 160. Correct?
Yes.
Now, if they accept a new partner with the one that he comes, now if those two getting the new partner, which is Devon, and he invests 80,000, how much will be the total? $240, correct?
Yes.
Now, how much will be his share now? Exactly 1/3. Make sense?
Yes.
But 80,000 is exactly 1/3 of 240. So in that case, he's gonna get 1/3 of the partnership. And that will be exactly how much he's gonna contribute. Because 1/3 of the partnership is $80,000. And he investing exactly $80,000. So in this case, there will be no premium, no deduction to the existing partners. Make sense?
Yes.
So now, let's see the second scenario. Second scenario will be that will be scenario 1. Second scenario will be now those two people, I have to change the name. Nagasawa capital, he has 70, and went capital, now we having only 80,000 here. That's 150. Alana comes in the picture and she wants to invest in the partnership 90,000. She investing 90,000. Right? But with the 90,000, so watch this. So now with the 90,000, she getting only 1/4 interest in exchange of the contribution. Make sense? Do you understand this logic?
Yes.
So how much is 1/4? That's 25%. Correct? So if this is a 25%, 90,000 is 25%, that means the other partners is going to have increase. Make sense?
Yes.
So the question is, how much will be that increase? Now we have to see she investing 90,000. She investing 90,000. Now we have to see how much is 25% of 240. So how much is that? Time 25. Oops, that's should be number amount. I want it. She's gonna get 60,000. That's how much she's gonna get. Now the partnership's gonna stay with the total amount here is gonna be 240,000. Don't get me wrong. That will be 240,000. Let's hand this one like this. So now the question is, what will be the proportion of those two? How much they're gonna get? Obviously, they're gonna get premium of 30,000 because there's a discrepancy between 90 that she's investing and 60 that she gets a share in the partnership. Make sense? So now those two, they're proportionally gonna share that $30,000 increase. Or maybe they can be, if depends how it says on the contract, or maybe they can share it equally. So what's going to happen? Since we have 30,000 discrepancy, those 30,000, one way to go equally to those 50-50. The other one is to base on the initial capital as a percentage as the ratio. In the question here, they share it 50-50. So that means this guy is going to get 15,000. So that will be new percentage will be additional. Let's go here. Let me insert one more line here. So now we have the difference of 30,000, right? And that 30,000 is going to be split 15,000 here to this account, 15,000 to this account. So this capital is going to become to the first partner is going to be 85. Second partner is going to get
95.
95, and the total is going to be 240. Make sense? So what will be the journal entry in this case? Journal entry will be debit, what we getting?
Income
Debit,
summary.
no, we get no income summary. She investing. What she investing?
Cash.
Debit cash. 90,000. We're getting 90,000 cash. Now she gets her capital account. Now we're gonna have credit Alana capital, and that will be only 60,000. What's gonna happen with the other two people? They're gonna get increase in their capital. We're gonna get credit Nagasawa capital with 15,000, and we're gonna get credit in Went capital
For 15,000.
with 15,000. Now the question is, why somebody will be willing to invest $90,000 to get only 1/4 interest in the partnership, which is below what he investing? What do you think? Do you understand what's happening here? Somebody investing $90,000 and he gets a capital account only for $60,000. So she's losing right here $30,000. Why somebody gonna be willing to do that? Give me possible scenarios here. What do you think? Are you guys with me or you already tired?
Maybe they couldn't get a bank loan.
Actually, she get the bank loan because she get 90,000. She's contributing $90 cash, $90,000 cash, but she get hit on her capital.
Well, maybe because when you're the first time investing, you have to pay extra for
It's more
the
like so listen, it's more like she wants to go in the partnership.
yeah.
She's desperate to get in the partnership. Why? Because she's seeing something in this partnership that she wants to be. She wants to be part of this partnership. For that reason, she's willing to pay more just to get in. Make sense?
Ivan, is it like how
Yes.
lawyers join like a firm when they join a brand new firm?
It might be. It depends. Again, depends. Because if you're the new lawyer, right? New lawyer with no experience, no clients, not so whatsoever, but you want to join the partnership of the lawyer, partnership of the accountants, for example, the accountant's going to tell you, okay, yes, you can join, but you have to invest that much, and for those money, you're not going to get 30%. You're going to get only 20%.
Yeah, I think they call it a capital contribution or
Right.
something. Yeah.
Yes. So you have person who wants to come in. He's desperate because he's chasing long-term benefit. For that's the reason he's willing to pay more cash. Now let's see the opposite scenario. They might be the opposite scenario, right? What would be the opposite scenario? Let's go here. Let me share the slides. Where were we? We're here on so here when we're doing this, and obviously that's how we're doing the calculation. We're getting how much the two partners make, plus the new partners coming in. Total is 240. Now, how much is the 1/4 that we're giving to the new partner? That's equal to 60,000. But he investing 90,000. So do we have 30,000 bonus to the old partners? And cash, we're getting the cash. The old partners getting 15,000. The new partners getting capital of 60,000, and that's it. Now, it might be the opposite scenario. Now, watch this. The existing partnership, now you have 300, first partner 230, second partner 250. The new partner comes and investing $100,000, but he's given 1/3 interest. So let's see how this is gonna work. I'm still gonna use this Excel spreadsheet and I'm gonna flip it here. And this is the picture now. We have page capital, which is page capital is 230,000. And we have gold capital, and that's 150,000. So the total capital is 380, right? So we have those two, and we're getting the new one, which is Martin. So we have 230 here. We have 150, and Martin investing 100,000, right? But he gets 33%, 1/3. 1/3 is 1 divided by 3. He gets 33.3. Make sense? Now the total here, so now we have to see how much is that one. So for 33%, he getting capital account for 160. So he's investing 100, but he getting capital account 160. How much is the difference now? 40,000. He getting more. So what's going to happen with those two? They're going to get deduction. This is going to get minus 20,000 if they're sharing 50-50, and this is going to get minus 20,000. So if they do that, what's going to be the new calculation here? 210 for the first one, 130, and the total should be, not that one, total should be equal to all those three together. 500, that's not my total. So there's something wrong here. That's 560. No, my total here, my balance here is 60,000, right? So this is gonna get deduction 30,000, and this is gonna get deduction of 30,000, and that's how I'm gonna balance it. So in this case, the new partner investing $100,000 cash.
Yeah, but we have to debit.
Now he's gonna get in his account credit. He's gonna get Martin.
Yeah.
Capital.
But the other partners we have to debit.
Right. He's gonna get 160,000. And that's too much. Let's give him one less. And the other two partners gonna get hit now. Page. Capital. And that's gonna be, let's move this 100,000. Let's move it 100 here. Page gonna get 30,000 reduction in her capital. And the same thing is gonna happen with the next person. Now the question is, why the old partners will be willing to take this hit? What do you think? Why the partners want somebody to invest $100,000 and give him capital account $160,000? Is it possible? On the other words, who is now desperate to go to the partnership? Is it the new partner, or the old partners wants desperate the new partner to come in? That's how we should look at the question here. When you see in this scenario, the new partner wants desperately to go in the partnership, where in this scenario, the old partners wants the new partner desperately to come in the partnership. Make sense?
Yes.
That's the only way they're willing to take a hit on their capital just to have him in the partnership. Because now the old partners see the benefits of having this person in the partnership. Okay, so I believe that's about it. That's the only thing that I wanted to tell you. Let's see the slides, how they're going. So with the third, so now he's doing the same calculation. We're seeing that there's a discrepancy of $60,000. And in this case, they split it different way. We split it 50-50. They can go different way. And this is some questions for you. If you want to do those questions, try those questions at home and see how they go, question 5 and question 6. Withdraw the partners, that's getting too much. We're gonna stop again. I'm gonna stop up to here, even though this one is, we're accepting the new partner, that's too much. The only thing that I need you to remember is we are, on this chapter, we are up to allocation of the income. For the final exam, up to allocation to the income. I don't think I'm even gonna ask you to close the capital, the withdrawal account into capital. That would be too much. But on the quiz, if I decide to put some questions about accepting the new partner and allocation of the, is it premium, is it the hit to the old partners, I'm gonna let you know. Okay?